Most traders jump from one indicator to another, hoping to find the perfect entry tool. But the truth is, real consistency in Forex comes from understanding how to combine indicators for context, not just signals. One underrated combination? CCI and momentum indicators like RSI or stochastic. Let's break down how you can build a clear, logical trading strategy using the commodity channel index, unlike moving averages that lag behind price. CCI can signal potential turning points early. When it drops below -100, it may show oversold conditions or early signs of bearish pressure. It moves above and below a zero line and is typically used with plus or minus 100 thresholds. And momentum tools to find high probability entries, manage risk, and improve your win rate. These indicators measure the speed and strength of price movements, giving you a sense of whether momentum is building or fading. What is the CCI and why it matters in reality? Its real power comes when you combine it with momentum confirmation. The CCI, or Commodity Channel Index, is a leading indicator that measures how far price has deviated from its average. When CCI rises above plus 100, it often indicates a strong uptrend or an overbought condition, depending on context. But here's where most traders go wrong. They treat CCI as a simple overbought, oversold tool. Combining CCI with momentum indicators? Let's add a second layer. RSI, or stochastic oscillator. Here's a step-by-step structure for using both. Step 1. Directional bias with CCI. Start by identifying whether CCI is above or below zero. Best to wait. Above zero. Bias is bullish. Below zero. Bias is bearish. But don't act yet. Just use this to frame your strategy. Step 2. Signal confirmation with RSI or stochastic. You're not chasing. You're entering with the trend with confirmation. Check RSI or stochastic. If CCI is rising and RSI is crossing above 50, you've got momentum plus directional alignment. If CCI is below -100 but RSI is still rising, conflict. This double filter system reduces false signals and gives you more clarity. Step 3. Entry timing. Use pullbacks to enter. Wait for CCI to dip towards zero, but stay above. RSI, stochastic, to stay bullish. That's a low-risk continuation entry. Step 4. Risk management using a TR. Now layer in a TR to determine stop loss and target. Set SL at 1.5 ATR below your entry. Set TP at 2 ATR or next structure zone. This keeps your strategy based on market conditions, not guesswork. Example trade setup. Let's say you're watching your USD on the 1-hour chart. CCI is above plus 100, gives market is trending up. RSI is holding steady at 60 to 70, gives bullish momentum. Wait for CCI to pull back to plus 50. RSI still above 50. Enter long. Gives SL equals 1.5 times a TR, TP equals 2 a TR, or resistance zone. Result. You enter during a healthy pullback, not when the trend is exhausted. Final thoughts? Using indicators alone won't make you profitable. But combining context tools like CCI with confirmation indicators like RSI or stochastic gives you structure, discipline, and confidence. This strategy works best in trending or volatile environments, especially when backed by clear risk management. At Innohedge, we don't chase signals, we build trading systems. If you're ready to upgrade from scattered indicators to structured strategies, join Innohedge today. We'll guide you step by step, from tools to risk to real-world execution. Links in the description. Start trading with logic, not emotion.